our GSMS analysis, and this time we will discuss macroeconomic configuration. My name is Anthony Peter Miller. I'm a professor of economics at the Brazilian University UFS in the northeast of Brazil. Here is my email address in case there are some questions. Let's go on. Now here are the background text with links to download. Just what we try to analyze, basic macroeconomic configurations. We have at first productivity-led deflationary economic growth, second monetary price inflation, third monetary hyperinflation, after that monetary price deflation, then deflationary depression, and finally inflationary stagnation. In this session, we will treat productivity-led deflationary economic growth and monetary price inflation. Just a short, quick survey of our model. It's based on the equation of exchange. Up here, we have the equation for exchange. Here is the Fisher-Chicago form, and here the Cambridge cash balance, and we use this formulation of the equation of the strict separation of the good side and the money side, and we have here the price level output. Here is nominal income, national income, GDP, the money curve, the money side curve, macroeconomic liquidity, and there are the natural production frontier and the cyclical production frontier and the absolute production frontier. We tried to explain these points in an earlier video, so this is just a short recapitulation. Here is the money side, and it's a curve that on the downward increases purchasing power at a given size of macroeconomic liquidity, and changes in the amount of macroeconomic liquidity will move the curve to the right when it's an increase and to the left when it's a decrease. Here are our production frontiers, the absolute, the natural, and here the cyclical. And here is an important point. Our analysis is based here at the side of the cyclical production frontier on the output curve of a business, the profit. Profit depends on the sales. Sales are prices multiplied by quantity. Here are the main cost factors. The cost for capital based on the interest rate, cost for labor based on the wage rate, and here productivity. Let's assume the productivity increases, the curve would move to the downward, and so ceteris paribus, our profit would increase. On the other hand, a rise in wage rate and a rise in interest rate would move the curve upwards. Here is our model for the deflationary economic growth. It's based on the equation of exchange and on the profit curve, and we come to the conclusion that simply, if we bring it down to the main points, that when macroeconomic liquidity increases more than output, there will be price inflation, and when output rises more than macroeconomic liquidity, there will be price deflation. Now, let's assume there is a productivity rise. This would move down the prices and move up the quantity. Now, here it is. We have the natural production frontier. Now we have a productivity boost, and the curve of the cyclical production frontier moves to the right because costs are lower now. And the result in our model is quite clear. The price level will fall and output will rise. We will get a new natural production frontier. And this can be called the natural way of economic growth. So let's not be deceived by thinking that natural economic growth should come with price inflation or should come with price stability based on the logic of the process of productivity gains. It will be deflationary economic growth. Now to monetary price inflation. Here something else is happening. Macroeconomic liquidity rises. We move along the cyclical production frontier. Now here too, output expands, yet it comes with a higher price level. Yet this higher price level will induce, in due course, that wage rates will rise, that nominal interest rates will rise, and then our cyclical production frontier will move up, as we explained, because of the cost factors, and we will even have more inflation, and we will move back to the earlier natural production frontier. Now here there's a movement A, B, C, quite different from the deflationary economic growth. Here is the formula once again, and here macroeconomic liquidity goes up. This rises, it makes prices rise, quantity increase. This will make, after due course, interest rates go up, wage rates go up, and then we have a higher price level, and we will finally shift back to the old natural production frontier. Thank you very much. Here is my author side at the Social Science Research Network, and in case there are some questions, here's the email. We will, in due course, produce several more of these short video clips to make you familiar, I think, with this breakthrough in macroeconomic thinking, and which captures really, I feel, how the economy works, because it is not a model that shows what government should do, but it shows how the economy works. Thank you very much.